Mutual funds aggregate capital. They pool money from millions of investors into a single massive fund. But portfolio management services, or PMS, operate on a strictly isolated architecture. Each investor's capital is kept in distinct, separate accounts. Under SEBI regulations, a portfolio manager is a specific body corporate. Pursuant to a legal contract, they advise, direct, or undertake the management of a client's portfolio of securities and funds. The entire operational framework for these managers is dictated by the SEBI Portfolio Managers Regulations of 2020. These regulations set a strict threshold for participation. To enter the PMS ecosystem, a client must make a minimum initial investment of 50 lakh rupees. Because the minimum ticket size is so high, the structure abandons the unitized one-size-fits-all approach of mutual funds. It mandates highly individualized portfolio management. This individualization requires absolute segregation. A portfolio manager cannot legally commingle one client's funds with another, nor can they mix client assets with their own proprietary corporate funds. SEBI mandates this exact architecture to create a strict fiduciary wall. If one specific portfolio takes heavy losses, the financial damage is contained. It cannot bleed over and infect the assets of other clients. Within that isolated architecture, the legal liability of the portfolio manager shifts depending on the locus of control. This diagram illustrates the two critical variables that define this relationship: who makes the investment decision and who executes the actual trade. In a discretionary PMS, the portfolio manager holds full authority over both functions. They decide what to buy and sell, and they execute the trades independently, following a pre-agreed strategy. In a non-discretionary PMS, the dynamic splits. The client retains full authority over the buy and sell decisions, while the portfolio manager executes the trades. Under this non-discretionary model, the manager acts purely as an execution engine. They cannot act without explicit prior authorization from the client for every single transaction. Finally, in advisory services, the manager merely suggests investment ideas. The client holds absolute control over both the final decision and the physical execution of the trade. The discretionary model places a heavy administrative and execution burden on the manager, while advisory leaves a lightweight footprint. Let's look at the physical infrastructure required to legally operate a discretionary or non-discretionary portfolio. This diagram maps the cash segregation mandate. A portfolio manager is legally required to keep client funds in a distinct, separate account at a scheduled commercial bank. Second, there is the security segregation mandate. All purchased securities must be held in individualized demat accounts. A portfolio manager is strictly prohibited from holding client securities in its own name, even if a contract attempts to permit it. To manage the actual safekeeping of these securities, the manager must appoint a SEBI-registered custodian. This is a vital third-party entity holding the assets in trust. There is one specific exception to this rule. While custodians are mandatory for discretionary and non-discretionary models, they are not required for purely advisory services, where the client handles execution themselves. This infrastructure triad, the bank account, the individual demat, and the independent custodian, guarantees that the portfolio manager never physically possesses the client's wealth. It eliminates the operational risk of misappropriation. With the assets securely housed, we need to examine how market orders are legally processed within this walled garden. There are two valid execution pipelines. The manager can use pool execution, trading for all clients together and allocating shares pro rata at a weighted average price. Or they can trade directly in the individual client's name. To prevent excessive risk-taking, SEBI imposes strict prohibitions on these trades. A portfolio manager cannot borrow funds or securities on behalf of a client under any circumstances. They are also prohibited from leveraging the client's portfolio to amplify derivative positions. Total derivative exposure can never exceed the total portfolio value. Off-market transfers between client accounts are strictly banned, save for highly specific operational exceptions, like settling a client's own trades or providing margin. This document is the most important Terms and Conditions Form, or MITC. It formalizes all of these operational boundaries and precise fee structures during client onboarding. It gives the client clear visibility into exactly what the manager can do and what it costs. Clients always maintain the right to withdraw their funds prematurely. However, to protect portfolio liquidity and discourage rapid churn, SEBI strictly caps the exit loads a manager can charge. This chart illustrates the maximum exit load limits. If a client redeems within the first year of investment, the manager can charge a maximum of 3% of the redeemed amount. The rate steps down over time. It drops to a maximum of 2% in the second year and a maximum of 1% in the third year. After a period of 3 years from the initial date of investment, no exit load can be legally applied to the withdrawal. These rigid guardrails, banning leverage, restricting transfers, and capping exit fees, strip away the manager's ability to engage in highly speculative maneuvers. They force a long-term alignment with the client's actual wealth preservation goals. To keep this entire architecture compliant, the regulator requires continuous surveillance and reporting mechanisms. First is the record retention mandate. A portfolio manager must preserve books of accounts, balance sheets, and the documented rationale for every single investment decision for the preceding 5 accounting years. Second is the annual audit rule. Every individual portfolio account must be audited yearly by an independent chartered accountant to verify compliance with SEBI rules. Third is the mandatory appointment of a compliance officer. This individual operates independently to monitor legal adherence, report directly to SEBI, and ensure investor grievances are addressed within standard timelines. When we view the completed operational model, we see a highly structured ecosystem. The locus of control dictates the manager's authority, while the custodian and bank enforce strict asset segregation, all operating beneath a layer of independent audit and compliance. Whether acting with full discretion over a portfolio or merely advising on trades, the portfolio manager operates within strict boundaries. They are bound by absolute mandates on segregation, custody, and transparency. Mastering this intricate fiduciary architecture is an essential requirement. It forms the bedrock for anyone preparing for the NISM Series 21A certification and provides the regulatory foundation for a career in elite wealth management.